The markets finished a pretty decent week to the upside today on a relatively good note. A little bit of a down day, but nothing too major. Right? We still had some pretty good returns on some sectors in the markets. China really was a big factor in this week's move. China, in fact, the move China had is one of its biggest moves that we've seen, but is not without precedent. So we're going to take a look at how China performed relative to other times we've seen this move. We'll also take a look at technology and its role. Right? Remember, technology is the leading role in bullish markets, especially NVIDIA. We'll take a look at how that rotation has been occurring. We'll also take a look at the weekly moves, some of the weekly patterns that we're seeing now that we're at the end of a week, especially in the market forecast. There are some signs that suggest we might be towards the end of this intermediate run, so we'll take a look at that. Doesn't necessarily mean that the wheels are going to come off, but we'll take a look at some of these kind of moves that are showing some signs of exhaustion before we get into Monday's market outlook, where we'll take a look at some of the monthly signals. And I've shown you before, or talked about before, there's a monthly signal we're getting on the S&P that we've never ever gotten before on the market forecast indicator. So we'll break all that down in today's video. We'll take a look at our trade idea of a stock that we were bearish on, but has had a really good week itself related to Bitcoin. So we're going to talk about a bullish trade example based off the patterns that we're talking about. So I'll show you that with our trade idea of the day. So let's go ahead and get started. Today is Friday, September 27th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Click on our like button for today's Market Outlook video. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who click on this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line remains strongly in the upper reversal zone despite a small loss today. Near-term line dropping out of bullish territory, so this is day one of the near-term line dropping out from below 60. The momentum line is lower than the near-term line, so there's a chance the near-term line can catch down to where the momentum line is. Unlikely in my opinion. So again, we have two sessions, 2 days or 2 periods where the near-term line can go from above 60, to down below 20 and produce a bearish near-term peak. This is day one. Monday would be day 2. So it looks not very likely that we'll get below 20 because again, your momentum line, generally the momentum line has to be oversold. And it's not. It's lower. It has to be lower, but it also has to generally be oversold. And that's just not the case. So the odds of us breaking down on Monday are very, very minimal on that. But the near-term line is out of bullish territory. It's just not down. At least it's not even down in the lower half of the chart yet. You don't really get a new near-term low point until that happens. Right? We did get that today on the Nasdaq 100. So the Nasdaq has the momentum line in oversold levels, has the near-term line on day one below 60. So again, day 2 would be Monday. Technically, this is by definition an intermediate confirmation signal, so there's a good chance that we can bounce back up off of this, considering the strong bullish intermediate posture on the Nasdaq 100. Market sentiment's obviously rising, not back in the upper half of the chart yet, but it's getting closer to that being the case. If you look at the Dow Jones Industrial Average, you can see a little bit of a long upper shadow there. Again, just a small one. You don't tend to get too big at the upper ends because the ranges are really small. But the near-term line did jump off of what was a bullish low point yesterday. We had, again, 2 days. This was day 1 on Wednesday. Day 2 was yesterday. Did not get in the reversal zone. And then we bounced back up here. So far, so good on the Nasdaq 100, or Dow Jones, forming another near-term rally. A little bit of a long upper shadow. Remember that will act as a resistance level, like the Russell 2000s has been acting as a resistance level. We still haven't cleared that long upper shadow here. But its near-term line has bounced back up. So here's day one of the near-term line jumping up above 40, right? So to produce a bullish peak, it needs to go from below 40 to above 80 in 2 days. In this case, 2 periods. So in this case, 2 days. Again, the momentum line should be above the near-term line. It doesn't have to be, but it should be. Like, that's the ideal scenario. And ideally, even more ideally, it should be above 80. That will help bring the near-term line up above 80 itself on that second day. That's not the case today. The momentum line is down. It's lower than the near-term line. The near-term line looks unlikely to produce a bullish peak here after a relatively bearish peak. Now, it's not a lower low. So now the question will be, where's the next near-term peak going to be compared to this one? This is our near-term high that we had. And this is a really significantly higher near-term low point. Will we produce a higher near-term peak? Or are we going to end up either equal or below that one? So that's kind of something to keep an eye on as we head into a new week next week. From a weekly standpoint, let's take a look at the weekly chart. After producing a cluster last week, the momentum line has dipped down into bearish territory here. It usually doesn't stay in bearish territory for very long. There is precedent for it to come right back out of bearish territory without dropping into the reversal zone. But that's, again, it's when the near-term line falls out of bullish territory, that's our concern, right? That's when we're in pullback mode. And obviously that's not the excuse me, that's not the case for the S&P 500. If we take a look at the Dow's weekly chart, or excuse me, NASDAQ, let's look at the NASDAQ first, because this has been a big driver of the bullishness, right? Here. Sorry, doesn't need that. So we got the bull tag just a few weeks ago on the NASDAQ. We've been bouncing ever since. Near-term line is up, setting up a near-term divergence, right? Lower near-term peaks with a higher high. Same thing on the S&P 500. Again, same thing. The momentum line's down in the bearish territory. How bearish will it get? Will it be something like this, and we can just bounce right back up, or will it keep going down? That's the question mark for next week. I would expect we'll probably bounce back up pretty quickly here. Again, considering where the near-term line is and the likelihood it will stay up here in the upper reversal zone. The intermediate line is rising. That's a good sign. Now we'll take a look at the Dow Jones Industrial Average. Again, after getting a cluster last week, that momentum line dipping, we still have the bearish near-term divergence set up there, a strong intermediate posture as well. And then finally looking at your Russell 2000 on the weekly chart. Not nearly as bullish, but its near-term line has jumped up above. Its intermediate line still below the market sentiment. And the momentum line is a lot lower, right? It's almost actually into that lower reversal zone. So a little bit less of a likelihood that will stay bullish. It did go from below 40 to above 80 in 2 weeks. So that's a good sign, right? We were below 40 here and then boom, boom. But, again, considering, the likelihood of it staying up there is less likely, especially with the intermediate line, like I said, already below the market sentiment line. Let's take a look at the other weekly charts. We'll look at this weekly crossover chart. Take a look at that Heikin-Ashi candle. It is a higher Heikin-Ashi. We did get a higher high. We also got a higher Heikin-Ashi high, or close, excuse me. Those are both really good things. We did not close above last week's high. It doesn't always have to, right? It usually happens right when you come off of a low point, and then it's kind of harder to do that afterwards, and that's the case right now. That's not always. Sometimes it can happen kind of a blow-off type move like we saw here at the beginning of July. So the PPO is rising. You can see it's rising here. Still at pretty decent levels, 86th percentile for the past 3 years. The size of the candle you can see is not nearly as big as it was on this move. And hence the, again, a little bit of a divergent pattern developing as well. So the size of these candles, getting smaller. Now that happens. You can see that happens here. So that can continue to happen for quite a while. We can converge here for quite a while, as long as we continue to get higher Heikin-Ashi closes. That's the big deal, as long as that's the case. Your NASDAQ 100, you can see a nice good Heikin-Ashi close as well. Your Dow Jones Industrial Average, very good, strong, bullish close there. And then finally your Russell 2000. This one's a little different than the others. In fact, that we did not get a higher high, and the Heikin-Ashi close is actually barely higher. We are in the 94th percentile of how far up above the 30-month moving average we are, and the size of the candle is really coming down there. So, not so, we don't have the strength in the Russell. Like, this whole broadening trade's not really broadening as much as we really would like it to be. The other weekly chart sometimes we like to look at is this hull. You can see the daily hull is actually trading below the market right now. The Hakinyashi, at least, is trading below the green line that typically leads to a reversal. So that's something to keep an eye on, as the Hakinyashi differential here is below its average, and the PPO up here is flirting with getting below its average. Again, the IWM definitely is trading below. We actually had some bearish Hakinyashi daily candles. Let's take a look at the weekly version. And you can kind of see, again, the divergence that we've been having, especially on SPY. You can see that divergence here. We've been just clearly, like, we had the big surge, and we've been clearly diverging, and that happens, right? And again, you can diverge for a while until you finally break zero, and we're not to that point yet. We're not worried about it breaking below zero anytime soon. But it also limits our upside to a slow and grinding move up to the upside. Obviously, you take a look at the 3 green arrows. We have 3 green arrows across the board, except for the Russell's got that one little barely red arrow. It's also flirting with the red arrow on the MACD as well. So we don't have the green shading anymore there. But we're not, again, we're not close to 3 reds anywhere on any of these indexes. So that's a good sign for the bullishness. We are above all the moving averages here, right? We're above the 8, 17. They're both above, rising above the 30. That's all good. The MACD histogram is falling, as we just mentioned, but we don't have the MACD has not crossed below its moving average, and when it does, remember, as long as we stay above the 17, then at worst we're converging. So that's okay, right? That's a good sign. That's kind of what we're seeing here on the weekly chart, right? We're below or flirting with the weekly, the MACD with its moving average, but we are still above the 17-week moving average. So again, at worst, we're converging, similar to what we saw over here, and it just kind of leads to a slow grinding move up to the upside. Let's take a look at the DMI. The DMI shows no trend at all going on. Well, barely. Like, your DMI, you are above 20. The negative DMI directional index, is pretty low. But your positive just is not gaining any value. Like, again, other times that we've been this low, we've been clearly above 25. Like when we got this low over here, we were clearly above 25 on the positive directional index. In fact, we were clearly above 30. Over here, when we got to that level, we were almost at 40 when the negative index got to this level. Over here, when it dropped to this level, again, we were close to 40. So we're barely above 25. So again, it kind of goes to show the lack of strength that we have right now in the S&P. The RSI is barely above 60. At least it's above 60. That's bullish, but not necessarily the strongest pattern. We're not above 100 anymore, but still, at least we're in the upper half of the chart. So we're bullish. We're just not showing strong bullish trending patterns here. The Ichimoku cloud, again, above the green line. The green's above the blue. The Hakinyashi, the rate of change is positive. We're above the cloud. The cloud, to the point where it's green now. We have intermediate trend strength. We haven't necessarily broken the mature levels yet to where we're firmly established. But at least we're showing some signs of bullishness. We're not in the upper quartile, but we're close. The bandwidth is rising outside of the Keltner channels. You have some pretty decently strong momentum. Again, we're just not above the Keltner channels. So you look at, when we had momentum here, again, the kind of same thing. We never got above the Keltner channel, and the momentum was really strong. We just failed to get going on a trend. Over here, when the momentum was this strong, we were outside the Keltner channel. Over here, when the momentum was strong, we also were outside the Keltner channel. And then over here, when this momentum was just strong, we were also outside the momentum channel, the Keltner channel. So, like the last time when the momentum was even stronger, it's kind of a similar move that we're very strong on the momentum, but we're not above the upper Keltner channel. So again, we're bullish, but we're not clearly showing signs where we're like, hey, we're about to take off on a multi-month intermediate run here. It's actually looking like we're probably closer to the end of this intermediate run than we are the beginning of a new one. If you take a look at the intraday range, today's move, you can see it was a inside day. We did close below last week's high point, so, but I mean, pretty darn close. So again, bullish, just not as bullish as we'd like it to be, but still bullish. We did not get a higher high and a higher low. We did not close above Friday's high point. And we, again, we've already filled in this gap from yesterday. We just haven't finished filling in this gap from last week, right, from last Thursday, and we'll see if that ends up being the case. You do have a good bullish Arun pattern here. The range and the volume continues to be really small. The range at 3.8 points, well below the average. The volume at 41 million, also easily below that average. So when you look at these numbers, just continue to drop. We're almost back below 1.1. Again, getting below 1 really entrenches us in a bullish trend. And you can see the volume has been rising, but has some, at least now has some room to taper lower to, if we were to get established on a trend here. And then the other good thing too is that the VIX did not drop today. It rose actually 10%, ended up rising almost to 17 by the end of the day, up above 6. So that's a little bit of a concern there when you look at it. Again, it hasn't been a common thing. Otherwise, the correlations here would be positive, right? And that's not the case, right? It's still pretty strongly negative. We have seen times when it's been positive, and that leads into weakness, right, for the markets. So that wasn't necessarily the case here, unless you look at like a really short term, and you can see even then it was pretty negative on the last couple of days. In fact, you'd have to go pretty much to a 1-day correlation to find that. Well, they won't even show us that, but we were up today on both. Well, you can kind of see the correlation is, you would expect that it would be pretty positive. But that's not the case. If you look at the correlation, the actual correlation, again, over 2 weeks, like we typically look at, still pretty strongly negative. So today is an outlier day. Just something to kind of keep an eye on, especially with the VVIX where it's at. So here we were kind of hoping the VIX would break the 200-day moving average, and instead it actually closed up above the 17-day moving average. So that's not necessarily what we wanted to see from the VIX. We wanted to break below that to really establish on a bullish trend for the markets, and that didn't happen. And then we really want the VVIX to drop below 90 into kind of bullish levels here in the 80s, and it didn't. It actually jumped back above 100. So that's kind of a move in the wrong direction, and it makes you wonder if the VIX sees something going into next week that the rest of the market necessarily doesn't see quite yet. All right, if we take a look at what's driving this price action, let's look at today, and then we'll zoom out to the week that was. So here, let's just go to today alone. Again, remember on a day where the, kind of like I said, the VIX tells a little bit of a different story than maybe what we think. It wasn't necessarily the most risk-on day. Small cap stocks did well. In fact, at one point in time, small cap stocks were up 1 2/3% early in the day, and that was really the only thing. Like the Qs were down even at that point, and of course the Qs ended up down 0.5%. Gold is down after a very strong run, as you'll see here in a second. International stocks, including emerging markets, down a little bit after a big strong run that they had. In fact, now if we zoom out to the week, you can see the big run that FXI has had. Let me show you something here that I posted on Twitter here relative to FXI, so I don't have to recreate the charts. I can just show you here what I've tweeted. So here is this move right here. So this move on FXI, if you look at the DMI, is insanely parabolic. Like that's a big, strong, one of the bigger moves we've seen. In fact, if I were to go to the rate of change, here, let's leave that on for now, and let's go to the rate of change for FXI. And let's zoom, let's go to pretty much this week, right? We'll go to let's go out here to, let's go 7 days on the rate of change. What's really kind of where it had a little bit of a bullish bias, but it kind of gapped up on that first day right there here and took off. So we're up almost 23% in 7 days. Obviously the biggest move we've seen here in quite some time. So let me throw on a this line here at that level, 22.83. So you can see we've had a move over here off of that low point where we were up 21.5% over 7 days. So this is not unprecedented for FXI. Again, you have to go back to the bear market lows, coming off the bear market lows, as well as this move in the middle of a pretty good parabolic move in 2007 for FXI. Right, so there has been times where we've been this bullish. If I were to come back over here, and that I highlight that here actually. There's been other times, two in fact, that the positive directional index is closed above 60, like we saw today, and the negative index closed below 10. Right, twice in the history of this ETF. Once was in 2015. Once was in 2017. 2007, as I showed you, the negative indicator didn't fall that far. And so you can see that, again, both of those we were bullish for a while, and they led into some, basically some peaks. So it's kind of like what we see here. We've been bullish, pretty much. We bottomed out at the beginning of the year. We've been rising ever since. So a nice little run for FXI. It's been outpacing. In fact, if you look at when it started to outperform, it was on January 22nd when we hit that low point I showed you. So start 21st. So starting on the 22nd here, you can see that EEM really started to outperform. Actually, I guess it was starting on the 22nd. So let's go up to the 23rd. There we go. So EEM has been outperforming IWM, or excuse me, SPY, the S&P 500, and the Qs, and IWM as well as the FA, because of this late, late push, and has been outperforming for a good chunk of the year. So FXI has been relatively bullish for most of the year, and then now has gone parabolic, like extreme parabolic. So I tweeted that out. I also tweeted out, let's see, this one here. So, let's see, let's come back here. I can show you on this one. So this came out that the stock market posts its best week as widespread stimulus begins. Well, and this feels frightening familiar, because in January of 2008, this week right here, the very last week of January, Congress introduced a fiscal stimulus bill. The Fed cut rates that week of 50 basis points. They had cut rates the week before on an emergency cut of 75 basis points. And then this was that last week of January was their scheduled meeting, and they cut it another 50 basis points. And that same week, Congress introduced fiscal stimulus package, tax rebates and things to try to stimulate the economy. Again, in January of 2008. So remember, the bear market occurred in the middle, started at in the middle of 08, when we finally broke that 200-week moving average, and then we washed out in the famous October-November move of 2008. So this was early in the year, when we were still in correction mode, because there's stages to a bear market, right? The early stages are pullback, fail, pullback, bounce, correction, break below the 200-day moving average, then a failed correction bounce, and then then the move to and through the 200-week moving average, a return move back up to it, and it also fails, and then the bear market really kicks in gear at that point. So this is way early on, like in the correction phase. So we had just broken below the 200-day moving average, had not broken below the 200-week, had barely just gotten to the 200-week actually during this bearishness. We were bouncing off the 200-week, so we were in the correction bounce phase of the bear market when that happened. A lot of stimulus, biggest move that we had on the S&P, going all the way back to that first week off the bear market low point in March of 2003. So I mean, that's almost 5 years, the biggest move in 5 years, and we all know what happened afterwards, right? That bounce failed, and we continued, and so now the question is, are we going to get a similar failure here? In this case, FXI has already been below its 200-week. In fact, FXI has been in a bear market for quite a while, right? Since 2021, it broke its 200-week moving average and stayed below it. So this is what a bear market is, when you're below the 200-week moving average. We've had a good washout low point. We retested that washout low, and now we're getting stimulus. So now the question is this the breakout, right? Are we breaking through these highs and breaking above the 200-week moving average and moving higher, or are we going to fail here like we did in the S&P 500 in that January 2008 week where we were falsely bullish because of stimulus and it didn't work out, right? So that's a really, really important move that we're either going to build upon or not going into next week. If we can build upon it, great. Because again, everything else that was also in a bear market, like Germany, Germany was also in a bear market. It's come out of it. Japan was also in a bear market, and it came out of it. The UK was not in as much of a bear market, but it came out of it. France, let's see here, what's France? There it is, UWQ. It came out of it, right? So they've been clearly. So now it's really just been, and then of course U.S. never did. India never got into a bear market. The U.S. never got into a bear market in 2020. It stayed above the 200-week moving average for quite a while, and now we're in kind of converging, just like the U.S. But China, that's not the case. It's been in a bear market. It had the washout phase of the bear market where the MACD bottoms out on the weekly chart. That's always the again, you can see the washout phases of U.S. bear markets. If I were to go back, so we can see both of those. You can kind of see what a washout phase looks like. So there's the washout phase of the 2008 bear market in November. There's the washout phase of the July of the 2000s early 2000s bear market in July of 2002. Right, that's the MACD's the worst. We retest a low point and then we bounce. We retest a low point. In this case, we went a little bit lower, and then we bounce, right? That's how it works out. And so China has had that, right? China has had that washout low point here in October of 2022 when the U.S. bottomed out in its correction. It retested the low point in earlier part of this year. Obviously, the MACD is not as low. That usually doesn't doesn't match that low point. And then now we're changing. So really, really important. If we completely reverse that move, which there is precedent for us to reverse these big moves that are below moving averages. If we completely reverse this move, it might take a week or two, and we don't get back above that 200-week moving average, that's going to be an issue, especially, again, considering, look how big that volume spike is. We haven't had a volume spike like that since back over here in early 2022, and you can see we did reverse that movement. That was like an engulfing pattern. That was like the end-all, be-all of engulfing patterns there. And beautiful, absolutely beautiful, picture perfect. We should be bullish from there, and we were for a few weeks, but then we gave it back up about 6 weeks after that. Now, eventually, we tried to rebound again and ultimately failed. But that's what we don't want to see happen here, right? It's another big volume spike only below these moving averages, in this case just below the 200-week this time, and then we fail, right? That's the last thing we want to see here. The breadth actually looked halfway decent today, to the point where breadth is actually continues to be very extreme. So again, I tweeted out about this, so rather than recreate the chart here, I'll just come over here. Again, it's easy. If you follow me on Twitter, you get a lot of this stuff. Our McClellan oscillator, the McClellan summation index, is back above 1,000. Usually when it gets above 1,000, the oscillator turns negative. So we're not there yet because we were at 16. By the end of the day today, we ended up being at 15. We ended up being at 15. So we weren't at 28 like we were this morning, but we ended up at 15, right? So, but the oscillator is still well above 1,000. Still the highest level for the McClellan summation index that we've seen since early 2019. Now, we were coming off of a tremendous breadth thrust. We went from below minus 100 to positive 100, above positive 100 on the oscillator. We went from being below minus 1,000 to being above positive 1,000 on the summation index. That is the best kind of breadth you could possibly get. Right, we were pretty close to that happening here too, coming off of COVID. We were below minus 1,000. We got up almost to, well, we did, but it just took a lot longer. It took all the way to June of that year, so it took a few months more than it took right here. But you can see what the breadth looks like there. When we get above 1,000, when we get this high in the summation index, that's what the breadth looks like. That's not what the breadth looks like now. We had that kind of move early, like late last year at the beginning of this run. But when the McClellan oscillator was negative. But then now, instead of this being at the beginning of a move off of a negative number, it appears it might be closer to the end of a move. It might be more of a washout move to the upside. And you see that as well in other indexes, in other breadth indexes that we like to look at. So we'll look at the new highs is still very strong, up above 450 again on the net new highs. But when you look at the actual new highs here, it's not, so that hasn't been updated yet. It's not 426, it's 228 is what it will end up being. But even that's still a pretty good number, and the new lows drop back down to a pretty low number. So, and we are pretty extreme. Like, look at the number of stocks above the 50-day moving average, well above 400. You know, that's getting extreme. The number of stocks above the 200-day moving average, also getting above 400. So pretty extreme. So again, we have the combination of the number of stocks above the 50 and 200-day, both above their 80% marks, as well as the summation index above 1,000. I mean, that is, again, more indicative of a washout breadth move rather than a breadth thrust move, since we're not coming off of a negative number to begin with, which is typically what a breadth thrust. And a breadth thrust leads the beginning stages of a good market sentiment run, long-term run, rather than, in this case, potentially being towards the end of a long-term market sentiment run. All right, finally, let's take a look at the sector moves. So let's come over here first, and we'll take a look at the sector returns today, and then we'll zoom out to the week that was. You can see over 3 months, utilities and real estate are still killing it here. So if I come down to September and I do September 27th, you can see energy is the big winner today. Utility is also a big winner. Technology, the big loser. That's a red flag. And that's not a coincidence with it being a red line, but that is a red flag there. Now let's zoom out to the beginning of the week and see how things performed for the week that was. You can see, okay, well, technology is not the biggest loser, right? Energy was. That's why it did so well today. It was by far the biggest loser going into today. And technology was going into today one of the big winners. Materials was as well, thanks to, again, China stimulus. Materials really do well, again, because of their hopeful need for materials that they're stimulating their economy. But technology was doing pretty well going into this week. It was, did well at the beginning on Thursday when we ramped up, and then held, kind of retested those highs by the end of the day, and then a little bit of a pullback today. So just a little bit of a red flag there. But that's the issue. Like right now, everything is dependent upon NVIDIA outperforming XLK and technology outperforming the market. So you can see today, not the greatest day for it. Now, still above moving averages. So, and we're still above this moving average on the ratio chart. So that's actually pretty good, right? So we're not, we're not out of the woods yet. We're not necessarily like, tanking here per se. Here, let me just go to a regular chart here. This will be a little easier. And then we'll look at XLK to SPY. So there's your move. So we are above the 50. Now we are still below the 200. You can see our MACD. You can see that long-term PPO. And, are we peaking again, similar to what we saw here? Where we, also in this case got above the 30. In this case, we're above the 30 and the 50. Are we peaking here? That is a concern. Are we going to start rolling back over on this relative rotation graph without necessarily getting strongly into the leading category? You can see we're almost green, maybe a day away. That's if we keep going to the right on relative strength. But if we start to roll over, and you can see these other indexes starting to roll up, even energy outperforming, because energy doesn't outperform when the markets are bullish or when XLK is bullish. And of course, the big factor in this is NVIDIA, right? NVIDIA needs to outpace the market itself, and you can see it's not really blowing up anymore. It's still languishing. And the more it languishes, the more likely we are for the markets to just, at best, grind to the upside. Here's NVIDIA relative to the rest of XLK on a daily chart. Still in a convergence mode, right? We're falling below the average, even if we're still, well above the 200-day, the second number, and the 200-day. We're still in convergence mode. So, that's our best case scenario is the markets grind up. But it doesn't look like XLK or NVIDIA are like blowing up to the upside. In fact, it looks the other way around, that we might be, we've had some good momentum, but we might end up stalling here and rolling back down. XLY has been really losing momentum. It hasn't started to lose relative strength yet, but it's really been losing momentum pretty quickly. XLK is losing momentum, and XLC is no longer gaining momentum, even if it's still slowly producing some relative strength there. All right, that brings us to our trade idea of the day. It's actually in Coinbase. We had a bearish trade on Coinbase previously, but Coinbase really changed its direction in the last couple of days. Yesterday, breaking up to the upside and producing a bear tag, right, which can be the beginning stages of a bullish move, right? Bear tags can be the beginning stages. They can also be like reversal, like we can bounce down. We didn't quite get a bear tag there, but that's the idea. But today's move kind of helps solidify the potential of a new trend developing. Obviously, we're not dark green shading the green line yet. We're still light pink, light green, and a yellow line. But the near-term line jumping up to its highest level gives us a really good opportunity. The near-term intermediate line's already crossed market sentiment. It didn't cross it over there. We didn't get a strong near-term rally there, so a little difference, couple differences there. Well above the 30-day moving average, as you can see. In fact, we crossed up above the 10-week exponential moving average, hence the green arrow there. We are in a death cross environment, but the PPO is starting to turn up again. So there's some good signs, good opportunities that we can reverse up to the upside. You obviously have 3 green arrows on Coinbase. The last couple of days, we had some pretty good volume, as you can see down here. Really good volume, above average. We're above the 30-day and the 17-day yesterday. We're now filling in the gap between the 30 and 50. The MACD is positive, finally above 0. It didn't get above 0 over here. The stochastics did not get above 80 over here. It did now, again, with some pretty decent volume here. So those are all good signs. And then now you'll start to see some really good opportunities here for all these breakout patterns. So you crossed the positive, crossed above 25 and above the negative with a strong ADX. Even though if it's falling, it's still very high levels. That's a good sign for Coinbase. The RSI and the CCI jumped up, almost a 60 on the RSI, above 200 on the CCI, so we didn't get that over here. So that's a good sign for the stock too. Looking at the Ichimoku cloud, you can see we're not above the cloud. We're not a positive rate of change, so we're not there yet. But we ended the bearish trend yesterday, and now we're transitioning potentially towards the beginning of a new bullish trend now, well above the blue line. So that at least we're not in the bearish trend anymore. And then finally, on the Bollinger Bands, we did break up to the upper band, not quite above it, but to it. We are flirting with breaking above the Keltner channel. As you can see, we've moved up there. We've got positive momentum now that we haven't had. That's the first day of positive momentum. The green, we don't have green dots, but we have the, we probably will. There's probably one more day away from the bands getting back outside the Keltner channels, as long as we continue to push up higher. So what I decided to do here is to do a long call trade, selling the low 30s delta, buying 1 strike away for risk management. So you can see that we have a $400 risk, so less than our normal $500 risk, but more than a 2-to-1, almost about a 2.5-to-1 reward to risk ratio, with a lot of flexibility for timing on that entry. So I like that setup there. That's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.